We have Prateek Agarwal of ASK Investment Managers joining us right now. Mr. Agarwal, good morning and thanks a lot for joining us. This is Pavitra. You know, as much as we've been talking about the global backdrop, recession fears, inflation, the Indian markets seem to really be in a mood of their own. We're back above that 18,000 mark. How much of an upside do you see from here?
Sure. So a lot of things happening are not actually negative for the country, given our very large import. This thing, just import substitution could result in significant amount of growth going forward. The policies of the day do encourage that. I think looking at global data does bring down the mood a bit. But if one speaks to corporate India, they are showing a lot of confidence. If you look at capex cycle, all parts of capex, be it household in buying houses, corporate for putting up new plants, and government is looking up. It's no longer a drag on the economy; it's an engine of growth. So that is something that as Indian investors we need to be focused on. It is still good growth outlook is still positive. Yes, depressed global scenario does pull down our growth from or rather versus what it could have been. In terms of valuations, we are, I think, back to levels which are sustainable. Close to 18K on the Nifty. Let me put it this way: 93 till now. Earnings and market compounding have kind of mimicked each other. And that is one measure of it being fair. So going forward, one should again expect earnings growth kind of compounding from here on. On 10-year PE, which is something that I look at, we are at sustainable levels. Yes, bond yields to earnings yield does point to bonds being favored over equities just now, which again means that we should see some amount of consolidation. Time correction can correct it, or yes, if yields fall with fall in inflation. So, in some sense, that is what we are looking at.
Hi, Prateek. Morning. But is that the reason that a lot of the savvier investors are sort of moving out of equity mutual funds? I mean, we saw the data just a few days ago, while SIPs, which is the retail investors, I'm assuming, are holding up. Looks like lump sum money is moving out. Is that the sense that there are better alternatives to equity at the moment? And how long do you think this feeling might last?
No, so whenever market bounces back, comes back to close to earlier highs, people who may not have booked profits at the earlier instance may do so. So this always happens. And at a high in the market, instead of putting in a lump sum, people would want to come in staggered over a period of time, especially given the uncertainties that we are faced with today. So I think that is a positive. Second, flows into mutual fund is just one bit of what flows from Indians happen to the market. I think with resumption of FPI buying and broadening of the breadth of the market, many retail investors may be doing it directly. So that again has to be factored in. I see flows from Indians into equity markets as very secular. Yes, it can have its ups and downs, but given the low percentage of equities in the asset book of an Indian, I think the journey has just about started. We have a very long way to go. So these flows should be taken as very secular and should continue deep into the future.
Hi, Prateek. Long while since we spoke. Nigel on this side. Well, that's right. Equity as a percentage of household savings, I think it was around 2-3% odd. That's moved up to 6-7% odd. But the scope for growth is tremendous from here on. But glad to see an equity cult being developed here in India. Since things are looking up, Prateek, what's the single biggest risk to our Indian markets out here? Global risk, yeah, that's there. If the globe goes in for a tizzy, then obviously India as well will get hit. Hopefully, we don't get hit as hard. But otherwise, what's the other risk we're looking at?
No, so once again emanates from globe. If globe doesn't grow and we try and grow in that kind of a situation, so our start point is a high trade deficit and it can balloon. As yet, the situation is in control. We have one of the largest hoards of forex in the world. And that's again one reason why our markets are able to function normally and respond to earnings, unlike many other emerging markets. But we will have to watch the space. The forex reserves have been dropping. We are down 90 billion at a pretty rapid pace. Another 90, 100 billion down would make our import cover, I would believe, just about 7 months or so, 7 to 8 months. And that is when we may see Indian policy making getting more neutral and less positive for growth. Because it cannot happen that we continue to grow so strongly, sucking in imports, and slowly you continue to see, forex getting lowered. As of now, very sustainable. I think up till 400 odd billion dollars, it should be sustainable. But if it goes below that, we would have to watch this space. Secondly, what also happens is if forex goes out, there is automatic tightening that happens. RBI buys rupees, sells dollars abroad. So, unless it, on the other hand, increases liquidity in the system in some manner, we may end up seeing more neutral monetary policy and maybe getting onto the tightening side sooner than expected, which may not be pro-growth.